After our latest CPI report depicted the slightest decrease in inflation, market bulls came out to rally, thus sparking the S&P to rise by over 2% this past week. But now, with such a lack of clarity on interest rate cuts, many investors are actually flocking to value, meaning discounted dividend stocks are harder to come across. However, I have 6 discounted opportunities for you to actually consider that I don't want you missing the boat on, which I'm going to cover just after I hit on all the need-to-know economics. Ready? So as we wrap up earnings season, with a lot of the hype now beginning to quell down, investors have their eyes and ears back on the Federal Reserve, and rightfully so, because this whole penny pinching, very budget restrictive type of environment that we're living in really is all on the Federal Reserve. Now, that shouldn't be new news, and if you've been subscribed to the channel, you would have known that. But if it is new news, I'm going to highly encourage you to actually subscribe right now so you don't play that fool's game of investing on emotions during all the ebbs and flows of the market. But either way, you need to realize that market participants are really awaiting all the hints, clues, or just direct talk out of the Federal Reserve regarding interest rate cut guidelines. In other words, more clarity is needed. But that's impossible because even Jerome Powell is sharing that he lacks the confidence in the economic data, and that's leaving all of us now a bit squirmish. I mean, how long can we really sit comfortably in this environment as inflation continues to eat away at the value of our dollar while interest rates are actually keeping us locked down? Now, in the most positive news this past week, the latest inflationary report read that inflation ticked down to 3.4%. It's about a 0.1% drop. But perhaps, while it's not the greatest news, it is significant news and it sparked some green sparks in the run-up in the market. However, shortly after CPI was released, so too was data on producer prices, which jumped more than the expected, signaling inflation remains stubbornly elevated. Not the greatest of news, and this all just creates uncertainty and invokes the masses of investors to flock to more safety and reliability, meaning not a lot of dividend stocks right now are actually on sale. But don't be discouraged, because today I have 6 dividend stock opportunities that are currently trading at relatively attractive prices that could very well suit your portfolio and be exactly what you're looking for. So without further ado, dividend stock number 1, Nike, ticker symbol NKE, which is of course arguably one of the most, if not the most popular athletic wear and footwear brand. But as more of the luxury for consumers during these harder times, we obviously see lower sales, which leads to a lower stock share price. As noted, the stock is down by about 15% on the year, trading for $91 per share. Zoom out with me here just to see the power of Nike over the span of time. We see almost 180% worth of share price appreciation, all while analysts right now remain bullish, forecasting over 21% worth of upside, to which that share price should hit $111.44 per share. Not to mention hedge funds are also diving in on Nike, loading up on over 880,000 shares that were purchased last quarter. Now, for a shareholder of Nike, you're also going to enjoy dividends with a 1.61% dividend yield that's growing quite quickly here on average by about 16% year over year, while maintaining that 39-year dividend growth streak thus far. Next up, I want to go ahead and talk about a stock that I've actually mentioned here and there quite a few times on this channel, but it remains battered down and will likely be battered down until we get interest rate cuts. We have United Parcel Service, ticker symbol UPS, which is a world leader when it comes to logistics. But the key here is just noting that shipping has really slowed down, impacting the company's bottom line. So go figure, another stock in the red, trading right now for $147 per share. That's down nominally year to date after already beginning its ascent. However, if we zoom out, we're going to see over 100% worth of share price appreciation over the last decade. Now, analysts right now are agreeing with me here in terms of UPS's future, forecasting a share price to hit $163 per share. That's about 10% worth of upside yet to be enjoyed by all of us, while we have seen a recent insider purchase back in February, and get this, over 2.1 million shares purchased by smart money last quarter. Now, until we get an economic turnaround, the dividend is quite hefty here, with UPS coming in at a yield of 4.41%. That has been going strong now for the last 55 years, while growing on average by about 10% year over year. Now, another dividend stock opportunity that we have right in front of us is with Cisco, ticker symbol SYY, which is is a distributor of a range of food and tableware product for restaurants, cafeterias, and all the alike. So you can imagine that right now, with cost-cutting measures in place, and honestly just less consumers who are dining out overall, Sysco's orders are actually impacted, translating to a dip in that stock share price, to which we can see Sysco right now trading for $76 per share, PE of 18.5. But wait for the longer term with Sysco, because we're going to get a comeback. Sysco's past performance here coming in at 170% worth of share price appreciation over the last decade. Now in the interim, Sysco is certainly buying back shares, which should help with the stock's value. And right now, analysts are also favoring this pick, predicting a little over 14% worth of upside to hit a share price of $87.13 per share. That's about 14% worth of upside. Now with Sysco, you're going to go ahead and get a chunk of a dividend here as well, a 2.67% dividend yield, a 54-year track record of uninterrupted payments, while growing that dividend by roughly 8% year over year. Now investors, if those 3 dividend stocks didn't quite do it for you, I have 3 more coming on up that I'm actually very bullish on myself. But before I cover them, investors, I want to be insanely honest with you. I was a little bummed to look into my analytics and see that only 73% of you watching these videos are actually subscribed. Now, ultimately, I want all of you as intentional as I am on this financial freedom journey, and I believe the first route of intentionality on this journey is subscribing to the channel for stock ideas and market insights that you're going to need to actually level up as an investor. So join me here on this channel, but also tap on that thumbs up button while you're at it to just let me know that this is the content that you're getting value from and it's actually helping you so I can create more content just like this. With that, I want to kick right back into it with a healthcare gem that has been hitting some serious lows. That's Bristol Myers Squibb, ticker symbol BMY, which is a bio research and pharmaceutical whale producing some of our world's leading medications for a variety of serious illnesses. And just like many healthcare picks right now, Bristol Myers is down on the year by over 11%, trading for just $44 per share. And if you're long term on this one, you're going to see that we've had a deliverable here of 23+% worth of appreciation as analysts call for the stock to actually be on the come up, hitting a stock share price of $52.44 per share. That's about 18% worth of upside from where it is now. However, it's the most notable aspect here with Bristol Myers to understand the amount of hedge fund activity happening here. Smart money, having bought over 6.1 million shares last quarter. But until any major comeback, and even thereafter, Bristol Myers is very likely just to continue to deliver through on a higher dividend yield year of 5.44%, which has been steadily growing by about 4% year over year. Not the highest growth rate, but heck, we see over 53 years worth of a track record. Next up, Home Depot, ticker symbol HD. For all of you do-it-yourselfer investors out there, now as one of the leading home improvement retailers, Home Depot is, I think, a golden opportunity right now for the long-term dividend investor, and definitely an investment that's going to require an economic turnaround to see a real solid ROI. However, in the meantime, while mortgages are sky high, home building has just slowed down completely and consumers cut back on spending altogether. This is the time to look into Home Depot as it's trading for $342 per share. That's down from around $400 per share earlier this year. But zoom out with me here to see over 452% worth of share price appreciation. On top of that, we're also very likely to see the rebound here as analysts are expecting it to hit $392.82 per share. It's about 14% worth of upside. And in the meantime, we're going to get that dividend here as well, a 2.62% dividend yield. That's been shelled out for the last 36 years while growing by about 19% year over year for the last 20 years. Now, the one stock that I have certainly been focused on rather recently is McDonald's, ticker symbol MCD, to which I just made a much more in-depth video on solely McDonald's. Feel free to find that link right up above me and give it a click. However, thanks to our economic environment impacting consumers, as I keep saying, and inflation just outright impacting McDonald's, whether it's hitting the wage spikes or raw material costs, McDonald's has certainly been slipping up. Now trading for $273 per share, which is down by over 7% year to date. However, holding on to McDonald's for the long term will yield you a very nice return, in my opinion. We can already see over 246% worth of share price appreciation over the last decade. Analysts continue to favor McDonald's, forecasting a share price to hit over $300 per share at $306.17 per share. That's 12% worth of upside from where it is now, all while hedge funds continue to make money moves on McDonald's, and that's all on top of the company actually upping the ante on their share buyback program, again, just increasing the value of being a shareholder. Now, as for the famous off-menu gift, the McDividend, it comes in at a 2.44% dividend yield, been shelled out for the last 47 years, and then we have a 15% year-over-year growth rate. Not too shabby, but there you have them, investors. all 6 dividend stock opportunities. Let me know your thoughts on each of them, or if you have better ones in mind, certainly comment down below. But moreover, just be sure you're actually subscribed to the channel, and I'll gift you right now with your next watch by clicking right here for more insights.